I haven't heard anything from George.
Okay.
It's possible he may just be running a few minutes late.
Oh, absolutely. With the school year starting, I can totally understand that after the holidays. Okay, we've got a quorum, so let's call the meeting to order. First item on the agenda is the approval of the agenda and any announcements. Do we have any announcements? All right, no announcements. So, do we need to adjust the agenda in any way? If not, do we have a motion to approve the agenda as written for January 8th, 2026?
So moved.
Second?
Second.
We have a motion and a second. All those in favor of approving the agenda for January 8th, 2026, please say aye. Aye.
Aye.
Opposed? The agenda is approved. Next item on the agenda is approval.
Next item on the agenda is approval.
Tim, you might be echoing. You might want to mute yourself.
Sorry, that was me trying to get this to work. Apologies.
Next item on the agenda is approval of the minutes of the December 2025 meeting. Do we have a motion?
So moved.
A second?
Second, Dan.
We have a motion and a second. All those in favor of approving the minutes for the December 2025 meeting, please say aye. Aye.
Aye.
Opposed? Minutes have been approved. We'll now open the floor for any public comment. And we will close the floor for public comment. Next item on the agenda, VPIC presentation. Welcome, VPIC.
Thank you, John. Good afternoon, everybody. We had provided in advance a copy of our 2026 annual report. You may recall that when we were spun off into an independent commission, the legislature asked us to file such a report by the 15th of January every year. That report lays out in the executive summary some of our milestones over the last year. But long story short, we had another very good year with double-digit returns, continued to be at the top of the AIF ranking for public or for private equity returns, #1 among public pension funds for the second year in a row. As you read further down through that report, you will see that we've signed a more comprehensive memorandum of understanding with the Treasurer's Office to provide a higher level of touch in managing the OPEB assets. The OPEB assets are the assets set aside to fund post-retirement health care for both teachers and state employees. They're two separate funds. And historically, we had a much lighter touch on those assets, but with this new agreement, we have undertaken a number of more in-depth analyses to be sure we have strategically aligned the assets of those plans with the corresponding liabilities. First step in that process is an asset liability study that is underway. An asset liability study essentially starts with the actuarial valuations of those plans and then runs through a number of Monte Carlo simulations, looking at different outcomes for cash flows and investment options. As we get further into that study, we will be looking at a number of potential model investment portfolios for those OPEB assets, all with differing levels of risk, return, and liquidity. As we think about what VPIC is trying to do with these assets, our goal is really to maximize long-term returns within prudent levels of risk and liquidity. The liquidity piece, it's important that we have enough liquidity on hand to fund retirement benefits or healthcare payments in this case, also to meet capital calls to private equity funds as those funds call capital. But at the same time, having enough illiquid assets on hand to capture that illiquidity premium in the investment program. So a number of strategic analyses underway with RBK and staff in the Treasurer's Office right now. I would expect we'll have more visibility on the asset liability study by the end of the month, and into February have some visibility on a liquidity study in terms of how much illiquidity can the OPEB plans prudently tolerate. Also a pacing study and a pacing budget. So to guide us in thinking about how we commit to future private equity, private credit, and real estate funds in that sleeve of assets. Once we get through that process and we've identified funds that are appropriate, we would then go to the treasurer, make recommendations to the treasurer. He would then sign on to them because he's still the sole fiduciary and trustee of those assets. At the same time, we're working with the treasurer's office on legislation to formally make VPIC the trustee and custodian of those assets, in which case the treasurer's office would have a vote as a board member, but VPIC would be the ultimate investor, and those funds would be invested side by side with the 3 pension plans as well as the teacher supplemental COLA plan. That legislation, I understand, is being introduced today. We have looked at it and again worked closely with the treasurer's office staff. We're happy with the technical merits of that legislation. We support the idea. We think it's a win-win for the treasurer's office, for VPIC, and for Vermonters at large. We do have one sort of caveat on that piece of legislation. It's coming out of a discussion with VPIC in mid-December. And that is staffing levels. So we have been for a number of years now trying to increase staffing levels at VPIC. We're successful in adding an accounting position about 2 years ago. The fund has continued to grow in size and complexity and will continue to grow even more in size and complexity, assuming these OPEBs, oversight responsibilities for these OPEBs, does statutorily come to VPIC. When you think about the differences between investing the $7 billion that we have now versus potentially 10 billion or more as OPEBs come on and continue to be funded, you can expect a higher level of scrutiny and complexity, potentially more due diligence required on additional private equity and private market funds, as some of the funds that we go into are capacity constrained, and we may need to look at more of those smaller funds as we think about bringing on OPEBs. So we are asking for you to consider taking a position in support of this legislation with the caveat that there is some additional staffing. We've asked the legislature in our annual report to add it's called a financial director 3 position. That position would really serve as sort of investment analyst to support the 2 deputy CIOs I have. I think you both know Katie Green and Andy Cook. Katie oversees all credit and real estate. Andy oversees all equity and farmland. And between the 2 of them, to have an analyst supporting them not only provides us with a more thorough level of scrutiny of potential investment strategies, but also some potential succession planning and career path development in the event one of my 2 deputies are recruited away. Happy to walk through anything in the annual report. I hadn't planned on sharing screen, but happy to do so. Again, another good year. We appreciate your support. We appreciate the opportunity to manage these funds. We think we've optimized the portfolio at this point. When you look at our last asset allocation study, we did not recommend any changes to the strategic asset allocation. I suspect we'll be in the same position when we see the results of this current asset liability study for VPIC assets. In terms of the OPEB assets, when we can conclude that asset liability study, we could well see some strategic allocation target changes, as this is really the first asset liability study that's been done on those assets and those plans. Happy to take any questions or take the conversation off in any direction.
Time frame, Eric, in terms of just the analysis of the OPEB funds and getting those reports back, and then getting the treasurer's okay, and then going forward with that?
So under the current memorandum of agreement, I would expect the asset liability study to be completed by the end of January. I would expect a private market pacing study by the end of February. We could have a recommendation for 1 or more private equity funds in front of the treasurer in early to mid-March, before any potential legislation is enacted, if it's enacted. Once enacted, if this legislation is enacted, we would envision a transition period of probably 3 months where we would do a number of things. Number one, combine the treasurer's office existing contract with RBK into ours. We think there's some potential cost savings there. We've confirmed that with RBK. We would transition the assets from the treasurer's office to our custody account at JP Morgan. In the public market space, just about all, I think all of those assets are indexed. Excuse me. So we would redeem from those funds and essentially transfer cash, which we would then deploy into existing VPIC vehicles. Excuse me. In the private equity space, it's a little more complicated, but not a significant hurdle. There are probably half a dozen private market funds in the OPEB strategy now. We would simply do what's called a novation and change the name of the limited partner from the treasurer's office to VPIC. Going forward, as VPIC makes commitments to private equity funds and other strategies, the OPEB plans would simply take their pro rata share of those allocations. So we would be combining the three pension plans, the teacher COLA sleeve, and the two OPEB plan trusts into one trust for investment purposes. All of that would be invested as one investor under VPIC, and then we would track the account separately at the custodian. So again, short term, we probably have a recommendation for one or more private equity funds in front of the treasurer in early to mid-March. Assuming this legislation is enacted, we would probably be looking at an October 1st go live date for having all the assets come over to VPIC and be fully reconciled out to be sure that what was sent was actually what was received. And then we would be continue to implement those strategic asset allocation targets over time.
Excellent. Now you mentioned the legislation requesting additional staffing and support from the board. Timing for that for us to do a recommendation.
So we've spoken with the administration. Commissioner Gresham indicated a level of support for us having an additional position to oversee these assets. They did not add it to the governor's recommended budget, and I don't want to speak for the commissioner, but my understanding is that they're supportive of the position at VPIC. They're not supportive of it being a new position. I think his thinking is they would transition the position from some other organization to VPIC. We've said to him that we're agnostic as to the support or the source of the position, but that we really do need this investment or this financial director 3 position. Similar discussions with the treasurer's office. The treasurer, I understand, is supportive of us having a position. But I think his view, and correct me, David or Tim, is that if they were to keep the OPEB work, they would be looking for a new position to do it. If it comes to VPIC, we should be looking for that new position. So I don't think there's any real opposition to us getting a position. It's really just a question of what is the source of that position at this point.
Good. Other questions? Excellent. Well, Eric, keep up the great work. It's not like you're not busy.
Thank you all. Appreciate it. And we're around if you guys have other questions or need anything. Thank you very much. Appreciate it. Take care and happy New Year.
Thank you.
Bye.
All righty. Next item on the agenda is the RVK Capital Preservation Fund discussion.
Thank you, Mr. Chair. And we have Sarah Bochter here from RVK to help us walk through this issue. But as we discussed at our last meeting, we have been looking at our fund lineup after we received a member inquiry, noting that we really don't have a traditional capital preservation option in our lineup, that we had the Lord Abbett Short Duration Bond Fund as sort of the closest thing. And so what we did after that, we brought the issue to the board, and then Sarah and team at RVK have been doing a review of potential alternatives. I think we found one, and I think our goal today is to bring it to the board for consideration as a replacement option for the Lord Abbett Fund. Sarah will walk through this, and then I think what we're hoping is to answer any questions that the board has and move forward with the change. So Sarah, if you'd like to take away the presentation, and then we can go to Q&A.
All right. Thanks so much, Tim, and good afternoon, everyone. Happy New Year. So as Tim said, we prepared this search for you and recommendation that was really prompted by that participant request and the discussion we've had last time. Just as a quick reminder, the Lord Abbot Short Duration Fund is really been doing great. It's done its job. It outperformed peers. It's actually positively rated by RVK at this point. So, and it has behaved conservatively, like you would expect from a similar strategy as well. But if you look around the DC world, like we talked about last time, most plans will be using a more plain vanilla. A lot of plans will be using the more plain vanilla option, like a money market fund, especially nowadays where we've been going through a much more volatile treasury yield cycle than we've experienced in the past. And last couple of years, we've seen such changes in yields and rate cuts and rate hikes. And this really has impacted performance of even safer options and in the fixed income space, ones that folks might, expect them to be fairly safe, fairly boring. So that's why it's been something that we're having discussions with a lot of plans about. A lot of people now, the thinking is we want to have a stable cash-like parking spot be the capital preservation option in the plan. Easy in, easy out, $1 NAV. So put in $1, you expect to get $1 back, no price fluctuation. Government money market funds in particular are even the safest type of money market funds out there. They're the most common choice in retirement plans. They are regulated tightly by the SEC. Everything from quality to maturity to liquidity are heavily regulated, and that's why they can really make that promise of dollar in, dollar out. So simply in plain language, you should expect to get your money out in the same way you had if you're looking for higher yield or high return. The plan currently already offers another actively managed option of high quality return ESG strategy. You also offer the Vanguard as index option. It's the Vanguard institutional index option also as an alternative for those who are looking for a lower option. And that is typically how we see these plan names really designed, offering a safe vanilla option, and then offering for those looking for a higher yield, maybe something more with a longer duration with that tracks the aggregate bond index or something like a total return. So with that introduction and at your direction, we conducted this search. Our manager research team zoned in on 3 particular strategies within that space that they really liked. They are all institutional quality options, institutional share classes as well, meaning that they are the lower share class option available. They all have long track record, big asset base, and are all available on your Empower platform currently. If you look at their assets, they all have north of 100 billion in assets, multi-decade track record across all 3 of them. Their fees are generally competitive. They range from 10 to 17 basis points relative to a median peer fee of about 27 basis points. Notably, if you look at the yield, then we need to add that here, the yields are about 1 percentage point lower than Lord Abbott. And not surprised, response shorter duration.
Sarah, I'm sorry to interrupt. I'm struggling to hear. There's some choppiness in your mic. I wonder if you might want to turn off video and see if that clears it up.
Yeah, no, thank you for telling me, Tim. Is this any better?
That does sound better. Yeah.
Okay, perfect. So let me know if there are any other issues, and I can also dial in from my phone as needed. But to maybe repeat that very last sentence. So if you look at the 12-month yield, it is lower for around 1 percentage point lower for those 3 options relative to Lord Abbott. That is expected. On the one hand, they have a much shorter duration. So we're talking the typical duration of 3 months. That's the extent of the duration of the debt that they hold. So everything is pretty much cash-like treasury bills that will mature within the next 3 months, while Lord Abbott holds securities with an average duration of about 2 years, and they can hold securities with maturities even much longer than that, but that's the average. In addition to that, Lord Abbott can invest in credit sectors, as we talked last time, can invest in corporates, things that are higher yielding and maybe take on more risk. So that is what's driving that higher yield that you see there. But maybe taking a step back, all said and done, how did that impact performance over the long term? And that's what we look at on the next page. And interestingly enough, if you look at the long-term performance, the 7 or 10-year performance, the money market funds performance has actually been in line, if not even slightly better, in the case of Vanguard, for example, than Lord Abbott over that 7 and 10-year period. And the reason for that is, like I said, we've been going through this unusually volatile treasury cycle over the last 10 years. And with that, in a year like 22, where we've been through a very aggressive rate hike, that as you might recall, things that have that higher duration risk significantly underperform. So this volatility really eats up that yield and has translated into a very equivalent return over the long term. While a money market fund with a much safer, low risk approach was able to generate healthy, robust yield, especially in the last few years when treasury rates and Fed funds rate have been much healthier than we've seen in maybe the early years of the decade. So that being said, of course, money market funds are not meant to be a yield generator. There are other options that are meant to do that. Their goal is to be that steady Eddie type of option you have on the menu, very smooth, very minimal changes in value. Like I said, their performance actually year after year that you're seeing here on the page, you'll see that all three funds, if you look at the calendar year performance, they pretty much all three of them track each other. The three managers, the only difference there is pretty much the differences in fees between the managers. They all invest in that same boring treasury market. And that is obviously by design. So their performance is essentially tracking the Fed funds rate, the rate that the Federal Reserve is set. And they have just lowered it at their last meeting. So they are meant to track that, and over the long term, the expectation is that they will preserve capital as much as possible. But between those three funds, we really like Vanguard. Their fees are the lowest of the three, simply, and that's really great. Long term, like I said, fees can be all that matters and all that really varies or differentiates one manager against the other in that space. But in addition to that, we know that they have the scale, they have the performance consistency, and they also have the resources. They keep investing in their fixed income team. They really value and have the resources to support that strategy. So we really feel that this is a strong manager, and its lower fee makes it maybe a bit more attractive than the other two. Now, the next thing to think about here, unless there are any questions about the managers, what we want to be thinking about is how we can go about implementing this. And there are really one of two ways we can do that. We can either completely replace Lord Abbott with a government money market fund. The benefits of that is that everyone who's currently invested in Lord Abbott as the safest option in the plan will be completely mapped into this new option. And that is something you can easily do whenever you change a fund that is common and best practice to do that. And in addition to that, the menu itself will become simpler, become more in line with what we're seeing among other peers, as I mentioned, where we rarely see multiple fixed income options made available. And of course, it will make it easier for participants to make those decisions. And then for folks who are looking for more yield, like I said, they have a very strong actively managed core option in PIM for total return. And there are plenty other safer options on the menu as well, like the Vanguard Total Bond Index Fund. And then there's also a zero price stable, zero price balance in the balance fund as well, which is a very plain vanilla, safer 40-60 option that is also more conservative and is a good fit for folks seeking higher income, but with lower risk. So the other option, of course, is to keep Lord Abbett and the government money market fund. The benefit of that is that folks will have more choice. Those who are looking for that middle ground option will be able to invest in Lord Abbett. But the concern with that is that we will have less ground for making folks from Lord Abbett to the new fund. So anyone who is not checking their email or haven't seen the communication from Vermont and Empower about the new fund and who are actually seeking to be invested in a very conservative option may miss out on the change and may not move their assets into the new option, which might defeat the purpose a little bit. And of course, assets will end up being split between those two options. Less assets, more oversight, more complexity for the menu. So, which is why our thinking, but we would want to get your thoughts as well, and we're hoping to get your perspective here. Our recommendation here, given all that, is to fully replace Lord Abbett with a Vanguard cash reserve money market fund as the sole option, as the sole capital preservation option in the plan. This will give participants access to that safer option. At the same time, they will continue to have access to other options that provide yield and safety and conservative investments as well. So I did say a lot. So please let me know what you think about all this, and then we can maybe talk about potential next steps. But what do you think between those two approaches, or on the three managers we discussed so far? I see Dan raised your hand.
Yes, thank you. First of all, thank you for the presentation. Maybe this is a question for Tim and John and the whole group more than for Sarah, because I think it was an excellent presentation. And I don't have any arguments with what Sarah said. It makes perfect sense to me. I guess my question, though, sorry for the long intro. My question is it just one individual who called us and said, hey, where's your money? How come you're not offering a money market fund? And the silence of if it's one individual and all the other investors or participants are seemingly happy, I wonder if we're overreacting by, if we were to say, sorry, we're replacing it. So I guess that's my question. If it was a number of voices saying what the heck's going on, I totally would get it. But I just wonder if it's just really one or two people, does the silence of everyone else indicate they're satisfied? And probably this was a question to ask before from the outset, but I'm just kind of curious.
Dan, I wonder if I could speak to that for a second. So generally speaking, the sort of principle that you're talking about, I think we adhere to a lot. If someone has a concern about something, if it's a one-off and we look at it and we're like, okay, we think that's just a one-off kind of concern, then we may move forward without taking any action on it. Here, and what I will acknowledge, I didn't realize when we had done this previous work with RVK, we had looked at the 403B plans kind of writ large. And I hadn't realized that in the in the exclusive plans, we have the guaranteed long-term fund. That is a traditional capital preservation fund. What I hadn't realized is that we didn't have that option in the non-exclusive plan. And that's where I thought, well, it's great when the markets are rolling. But, particularly for folks that are approaching that retirement age and want to have the more traditional protection of a capital preservation fund, that's potentially a concern. And so it's not, I don't think of this work that we're doing as responsive to a single individual. I wanted to be candid with how this came about. I think of this as something that we looked at the plan, and it's kind of sort of our ongoing, keep looking at things, questioning them at the staff level. Once the question was called, it really, I started thinking, I think this may be something that we want to take action on, irregardless of how it came about to our attention. And then after bringing it up with Sarah and kind of getting her take on it, that further sort of supported the idea that, we're for this kind of issue, I want to bring it to the board. I think, it's not to say that what we're doing is wrong, or, I think the guaranteed long-term fund is a fine option for individuals, but it is to say that, we may be out of line with how most lineups are being conducted without having that traditional capital preservation fund option.
That's a helpful explanation, Tim. Thank you.
I also think it's really imperative for us with the exclusive and non-exclusive to make sure that we offer identical investment options, because it's the same pool of people. And if I'm non-exclusive, it's nothing that the participant has done. It's the school district that has more than one vendor. So I think as fiduciaries, I think it's really important for us to have as close to the same fund lineup for both of those groups.
Yeah. And that's why the first thing I think we've done once we had this conversation with staff is we reached out to Empower to confirm that the guaranteed long-term fund is still not available at this point to the non-exclusive plans, which they confirmed that they're not. And that's not a surprise to us. A lot of record keepers are wary of having non-exclusive plans being offered their proprietary income options, because they worry about excessive cash flows or changes on those plans. So it's really up to them to set the rules, and they have made this one unavailable, unfortunately, at this time. So something I think, Tim, we've discussed this already as something we can think about long term, is if maybe moving away from the Empower Guaranteed Long-Term Fund at some point might be a good idea. That could be even more attractive down the line when there is currently legislation in Congress to allow 403B plans to invest in collective investment trust. And if and when that passes, a lot of people are confident that it will. You will also have access to plenty more stable value options that are proprietary to Empower that we can consider. And maybe there's this discussion down the line that happens, it would make sense, and maybe try to find ways to align the major plans better.
Well, I want to thank you. All of you have answered my questions. I mean, I definitely can support Sarah's recommendation. So thank you for explaining.
Thank you, Ben. And I do want to confirm we do see a lot of plans today, especially for student plans, offering money market funds for that particular reason is they might be looking for something like a stable value option. They would like that additional guarantee, but having no access to that at this point in time, they really find money market funds, especially something like this, to be the second best thing. And there are folks who really don't want to have anything to do with stable value funds either. So we want to also keep an open mind. So definitely something we can revisit at a later date and discuss maybe with you all again. But at this point in time, we are stuck with one option that we can offer that is really very conservative, boring, plain vanilla, which is a money market fund for the non-exclusive, unfortunately, and then for the exclusive plan, we can have that option of something like the guaranteed long-term fund.
So at this point, the recommendation is to move to the Vanguard Cash Reserves Federal MMF as a sole capital preservation option. Anyone having any thoughts that that's not a good move to make, or have questions before I ask for a motion? All right. So do we have someone who would like to make the motion to accept the recommendation to move to the Vanguard Cash Reserve Federal MMF as the sole preservation fund from the Lord Abbot?
Mr. Chair, could I
Yeah.
maybe suggest, could I suggest slightly different wording?
I would recommend it, yes. What word would you like?
Well, I just want to make sure that it's clear that we're replacing. And so
Yep.
I think I would suggest that the motion be to accept the recommendation to replace the Lord Abbot Short Duration Fund with the Vanguard Cash Reserves Federal MMF.
Do we have someone comfortable making that motion?
I'm comfortable making that motion, John.
Okay, do we have a second?
Second.
We have a motion and a second. Further discussion? All those in favor of the motion, please say aye. Aye.
Aye.
Aye.
Opposed? Abstentions? Motion carries. Sarah, thank you very much for all the work on this. That was excellent presentation and great information.
Oh, no, thank you all so much and appreciate the feedback. Maybe just
will.
quickly on if I have, do I have a minute, Tim, or just on next steps quickly?
I was going to note that actually I was just going to jump on that and say that we are going to we're going to move forward with next steps, working with Empower to effectuate this transfer, and we'll come back to the board and apprise you as how this is going in our regular updates. But I think at this point, we're going to get to work and we'll let you know specific timelines as we move forward.
Excellent. Okay, thank you. Next item on the agenda, Health Spring Transition Update.
Great, and I'll start this off, and I have Steve May and Shauna Rink here to answer any questions that the board may have. But it was a pretty big deal between these last two board meetings. What has happened with respect to the transition? We've gone live as of January 1st, and I think the transition has gone well. As with any transition, there are challenges that come up. I think the first couple days it was mail being slow and still some folks not having received their cards. Now, as folks start to utilize the benefits, there's going to be issues that pop up as providers are getting used to the new insurance, members are getting used to the new insurance, and everyone's kind of figuring it out. But from my end, as we came through the end of December and into January, the transition has gone smoothly. I wanted to make sure to put this on the agenda just because, it has been a very important, big milestone in this big effort that we've undertaken. And I wanted to make space for the board if you had any questions, if you're hearing any feedback, to let us know. And I wanted to offer perhaps a quick view, Shauna, if you have, I know you have put together a couple metrics that you could provide to the board just to give sort of a quick snapshot of where we are.
Yeah, that sounds great. Thank you so much for inviting me. So just a quick update as it relates to the Go Live customer service experience through Monday, and I should say January 1st through January 5th. We've had approximately 1,200 calls, but we have had a really high, or I should say a really good average speed of answer. So we have been able to answer 96% of those calls within 30 seconds or less. Our goal is 85%, and the CMS requirement is actually 80%. So we have exceeded that average speed of answer. I would say the top retiree questions are very consistent with what we typically see. So is my provider in the network? Is my drug covered? Will my mail order prescriptions be transferred? How do I register for my myhealthspring.com? Have I have not received my ID card? So what we are hearing is a lot of noise regarding USPS delays. And that is not just in Vermont. So personally, I have experienced it. My team has experienced it unrelated to a HealthSpring ID card. So I think there's just been a lot of delay around the USPS mail system, not just in Vermont. We have had a few escalated concerns. They're primarily around provider guidance, eligibility messaging, and digital access support. So we are working with the training team to make sure that we are creating additional training materials, alerts, and as an example, within digital access support, some of the customer advocates were not consistently providing support and direction on setting up their myhealthspring.com site. So we did create a job aid for the advocates to have instructions on the myhealthspring.com registration. We provided instructions that could be posted on the VSTRS website. That information is also included in the member handbook. Some of the advocates were not consistently offering and proactively offering to reach out to the providers on the members' behalf. So that's definitely an alert and education that we have further emphasized the importance of that. So it's some of those things are very typical, but we do have the customer service director and the customer service supervisors continually monitoring and addressing all of the things that are related to VSTRS.
Thank you, Shauna.
Yeah, the other thing that I would just mention is we've had a lot of activity even going up to January 1st, as you all know. We sent out approximately 1,500 formulary notification letters. So those would be letters if a retiree experienced a negative tier change, a non-formulary drug, or CMS requires us to identify if the drug is covered under Part D. So it could be maybe like a Mounjaro where it is only covered for particular medical conditions and not weight loss specifically. So most of the time those medications, if it is a non-formulary, it would be covered within the first 30 days or a 30-day supply within the first 90 days. Through the transition policy benefit. But there are medications such as the Mounjaro as an example, where we do require prior authorization just to ensure that it is something that is covered under CMS. So we expect a little bit of an uptick in those questions or inquiries going into our customer service team, but we have created messaging for the VSTRS website. And we also successfully transferred 2,000 prescriptions for 600 members from Optum to Express Scripts. So those 600 members do need to initiate their profile and request the refill from Express Scripts, but those were successfully transitioned from Optum to Express Scripts. So that is something that is very beneficial when it comes to a transition. So we definitely are continuing to focus on continuity of care, providing our dedicated care managers to support individuals or retirees that are undergoing care or treatment. And also encouraging our provider liaison team to reach out if a provider or a retiree has a question about their provider.
So, and then from, just to finish on, we are continuing our couple meetings a week cadence with HealthSpring, where we're staying very closely connected so that we're able to communicate what we're hearing in our call center with HealthSpring, making sure that where we see issues, maybe if people are being pinged from one place to another, we can solve those. And so, I'm knocking on wood right now, but things are seeming to go well. I think I've said it before. I think I'll say it again. That's due in very large part to the work of Nicole leading this effort with our team, making sure that all our staff has what we need, and Bill keeping our website fresh, full of information for our members. So I think that it was great work on their parts, and here's it's not done, but I think we're in a good place.
Where are we with the talking with UVM and being in network?
Yes, so we actually have, we're continuing to have conversations with UVM. They did request a specific rate. So there is a governance meeting that is to be scheduled, and that should occur sometime in early January or mid-January, I should say mid-January. But that actually it's a very complicated process where they go through a pro forma and they identify, what rate they have requested, analyze claim, historical claims, etc. So it's a very complicated process, but that is still underway. But I know that within all of the administrative components, those have been finalized, and we're in a good place.
Excellent. And then I've got a question for you too. In setting up myhealthspring.com, there are a series of steps, and one of which is a health risk assessment. Can a member opt out of that, or is that mandatory?
That is not mandatory. It is completely optional. So that is something that they can complete if they would like to, but they don't have to.
That's not evident on the website.
I'm sorry?
So that is not evident when you go through the steps. When you get to the HRA, there's no options of saying yes, I'd like to do it, or no, I can't. There's a series of, I think, 4 different steps or 3 different steps to start your myhealthspring.com, but I certainly didn't see any option, nor did my wife.
So John, did you see an option to bypass it, or did you have to complete it?
All you had was a next button. There was nothing
Okay.
else.
So
I'm going to assume that people would be uncomfortable. I know I wasn't overly excited about it. I certainly would have opted out, but I didn't see that was an option.
Okay, let me take that back and check and see if there's an opportunity to bypass it, and I will get back with you.
Excellent.
Mhm.
John, do you have a question? Oh, you're muted.
Yes. Well, I found out there's a Jim Dugan in the state employment, because I tried to send some emails about this, but so we had some retired members actually reach out to me, but they're now fixed. But there was a little bit of confusion with like spousal benefits and stuff like that. So, but I think it looks like they're all fixed. My school also transitioned to HealthSpring to manage our HRA and FSA options. And so then one thing I noticed is if you want to be reimbursed, you have to connect through Plaid. You can't just use your routing and your account number. Is there a reason why you have to use Plaid, which then it looks like if you select Plaid, then they get to access, monitor your banking habits. They get to gather data on the money going in and out of your banking accounts.
Tim, does Plaid ring a bell to you?
No.
If you want to be
Did-
reimbursed.
Is this for this isn't for this insurance, this is for your active school HRA?
Well, it's
Or-
for the HealthSpring, like your app on your phone, the HealthSpring app, if you want to upload a receipt and get
Yeah,
reimbursed, wouldn't that be the same for your insurance too, or no? If you went and got prescriptions, would you be able to upload there wouldn't be a case where
I
you
think,
would be
we have
reimbursed?
we have two different things going on. I think your district has hired HealthSprings to administer your
Oh,
HRA. And that would be totally separate from HealthSpring Medicare.
insurance. But
Yeah.
like, is there ever a situation where you would be reimbursed through HealthSpring for your insurance?
Yeah, but it would be a different process.
Okay, so you wouldn't ever have money being deposited back into your direct deposit
I wouldn't,
if
Shawna,
you
do you
were
want to speak
applying
to
for
that?
reimbursement?
Yeah, are you referencing the Medicare Advantage plan?
Well, I was just thinking that if you ever were uploading a receipt to HealthSpring, I don't know if maybe in the realm of insurance, maybe you never would need to be reimbursed. But it said on the HealthSpring site, it said that if you require reimbursement, like say you're uploading a receipt for a reimbursement, that there's a $2 charge unless you are willing to commit to being in Plaid. But maybe that doesn't apply for anyone for the insurance. Maybe it's only for the third party management. Like there'd never
Yeah.
be a case where Jonathan would need like a check to be reimbursed for something.
There would be instances where you could be reimbursed if you had to pay out of pocket, which would be rare, but then there are instances where, like for the vision and the hearing, where if they're going out of network, they can access that service and then seek reimbursement. There is a direct member reimbursement process, but the Plaid is not ringing a bell. So I will touch base.
So
and
unless like that's, yeah, if you could check on that, because like when
yeah.
I went in and the system that I can see,
Mhm.
it says there's a $2 charge for every check that you get mailed to you. And your only option for being direct deposit, even if you're willing to share your routing and account number, is if you use Plaid, which is it's a competitor to Experian, TransUnion, and Equifax. They're gathering information on our actual bank transactions, like how much do you have coming in every month, how much goes out every month. They're going to be watching all of that if you give access to your account so that you can have a direct deposit. But you can check on that and see if for the insurance HealthSpring, is it different from the third party HealthSpring, that you guys have a different system? And we would like to have the system where you could just use your routing and account number and not have to commit to Plaid.
Yeah, and I don't believe under our direct member reimbursement, it would go directly to an ACH or the bank account routing number. It would be more of a check. So that may not be something that's consistent with how we manage it on our direct reimbursements. But I'll definitely follow back up and provide all of that information.
We did
Thank you
not.
very much.
Yeah, we did
Just-
not set anything up like that. And direct deposit and direct reimbursement is not anything that applies for these plans we have.
Shawna, you could just after you send that, you could just send it over here to Jim Duggan, and I can make sure that it gets back out to
Will
Genevieve.
do, will do.
Any other questions? Well, for the members that I've spoken to that have contacted me, the transition has been a smooth one. And I can't thank everyone enough for all the hard work doing this past few months and as we move forward. I'm thrilled we are where we are right now, for sure.
We will definitely continue to monitor the performance and the member experience and follow the trends and keep you all posted.
Excellent.
And
Thank you.
also collect the feedback that we receive from Nicole and Krista and the team.
Excellent. Shauna, thank you very much. I appreciate it.
Yes,
Tim.
thank you.
Steve, you too. And Nicole, as always, thank you for all you do in the office.
Have a great afternoon.
Thank you.
Thanks, Sean.
Next item on the, I'm sorry.
Oh, I just said thanks, Shauna.
Oh, next item on the agenda is member appeal.
So, Mr. Chair, I put a memo together on this topic. The member will not be joining, so I think not disclosing any names, I don't think we need to go into executive session. I'm happy to just characterize the issue generally. An individual member was a JROTC instructor for a couple years without having a state license. And as we showed in our board packet materials, that is a requirement for VSTRS membership. So when he was initially coming into the system, he did not pay in and did not receive service credit. He thereafter received his license and began getting service credit. So everything was administered according to how our policies and how we traditionally administer this. This individual asked if there was a way to get service credit for that time. And as we looked at this issue, we didn't see any error made, so we didn't see an opportunity to correct it in that sort of a way. We did, however, look at our purchase statutes, and I put the sites into the memo. There are a couple statutes that allow you to buy service for different causes. Like, for example, if you taught at a school in New Hampshire, you could buy service for that time as long as you weren't going to draw a New Hampshire pension for that time. Similarly, if you work, say, for a couple of years in one of our member schools and then leave and withdraw all your funds so you don't have any credit, you could thereafter buy that service back. So when we were looking at these, we thought, well, geez, it sounds like for an individual who worked in a school, didn't receive credit, credit that he could have received if he were working in another state, credit that he could receive because he didn't have, as if he were, if he could have received it if he were licensed and then withdrew and then wanted to buy it. We thought it made sense to exercise some discretion and allow him to purchase this service. We forwarded these materials to the individual who was pleased with this result. And so we just didn't want to make this new step without consulting to the board. We haven't previously allowed for this fact pattern to have the purchase option. So that's why we wanted to bring it to you, just to make sure that there was no problem on your end. I'm happy to answer any questions. We would be recommending a motion to grant the member appeal and allow RM to purchase service of approximately 2 years as requested in the, wow. That's wild. Sorry. As requested in the memo. Sorry, I got distracted by that bug.
Yeah, I was going to say that's a good sized beetle.
Yeah.
Questions for Tim about the appeal? Genevieve?
Just a quick question, that not that I'm against the appeal, but like when they purchase, that just asking for information. Because he would be purchasing his credits, but then the money that the school would have paid, how does that money get put into, or is that part of what you factor in?
So when someone
like-
does a purchase, we look at their information and they're like their salary, their age, and we have actuarial factors that give us that can allow us to calculate the value of 1 year of service on an actuarially neutral value to the state. So it's not cheap to purchase this service, but the purchase price will include the full value of the year. So it's not tied to the contributions that the individual would have put in. And remember, the school doesn't pay anything for this. It's the state that pays the employer share. So when you do a purchase, what we're really doing is trying to make the system sort of agnostic to the extra year. It doesn't gain us anything. It doesn't lose us anything. It allows the member to purchase. And so that we have that part all set. What we haven't done is allow for this specific fact pattern before. So we wanted to make sure that we ran it by you.
All right.
Do we anticipate making changes to our procedures to cover this more in general, or are we treating this as a specific one-off that we would not want to repeat in the future?
This is a pretty unique scenario, but we are going to review our purchase guidance to just make sure that we're contemplating this kind of scenario. I think this is kind of a one-off. You don't have a lot of JROTC instructors, and as the facts kind of show, the case is kind of further compelled because there's a lot of confusion about what was needed at the time. Someone thinking they got a federal license from the US Army. Did they need a state one? So yes, we're treating it as a one-off, but we're going to use this as an opportunity to review our purchase guidelines generally and see if there's any updates that are needed.
And this historically has been a little bit of a discussion issue with the ROTC programs being introduced into the high schools. It was like, what are they a member? Aren't they a member? And this board has faced this before. In fact, we actually had a vote on saying that you do need to be licensed. You had a follow up, Barry?
No, not exactly. If it were to become a more general procedure in the system, I'd have questions about how much service credit could be purchased, and I would wonder a little bit about the distinction between someone who's never gets licensed and someone who gets licensed and then goes back and gets credit for time that they weren't licensed, and also about other subject areas. I don't know why the ROTC period scenario should be treated differently than other people who might work without full licensure for a little while and then try to backfill it. But this stuff just gets complicated, and if it's a one-off thing and you've thought it through, then I don't have any serious questions about it.
Yeah, it does get complicated pretty quick when you start thinking about the many permutations. That's why we're kind of keeping it. We see this set of facts as somewhat unique, but whenever this comes up, we use it as an opportunity to just review our guidance and say, okay, is everything working as it should? Does this change our thinking on anything? And in that case, we'd have a deeper conversation with you about it.
Tim, would you like to read that? Genevieve?
Does any teacher, say who was a history teacher, if they taught for a year without their license and then got their license, they'd be able to buy that year, right? Or is that our policy now? Like if a teacher taught for a year without a license and then
I think we'd look at the facts. I mean, I don't think that typically, I don't think that happens a ton. Because most of the time you're required to have a license in public schools to teach. So,
right. But you're saying that because it sounds like the ROTC, their JRTC, they're treated differently than, so like a history teacher who taught for a year without a license and then they get their license, they could go back and buy that year, or are they already paying in for that first year? Because here at North Country, we have quite a few people without licenses. So just
they must be on waivers.
They must be on waivers or
so they would be paying into the system.
Yeah.
Yeah. The difference here is that I think there's a confusion about what was needed and just a lack of understanding on everyone's part. And I think everyone followed our practice kind of by accident. Followed our policies how it came out. So that's good. but at the same time, we see this, you know, as a reasonable accommodation for this specific set of facts. And as always, if it gets to be more of something we see more, we'll more formally investigate our policies and figure out what we're doing. But this is kind of getting back to Dan's point earlier. This is sort of a one-off, you know, and we wanted to react appropriately and thought that kind of some flexibility was the right answer here.
Tim, would you read your suggested motion, please?
The motion was to grant the member appeal of RM and allow RM to purchase service of approximately 2 years for time served as a JROTC instructor.
Do we have someone comfortable making that motion?
So moved.
Second? Do we have a second?
Second, Hamby.
We have a motion and a second. Further discussion? Hearing none. All those in favor of the motion, please say aye. Aye.
Aye.
Opposed? Abstentions? The motion carries. Hey, legislative update.
All right, thank you. What we wanted to
Day
just
3.
do, yeah, it's already going. We had House Appropriations actually took testimony from the JFO analyst today on pensions, history, funding, all those topics. Tomorrow I'll be providing a 101 to Senate GovOps, maybe House GovOps. And I know Treasurer Pichak was just in Senate GovOps as this meeting was starting, introducing our Treasurer's Office Omnibus Bill. And that's what we put in the materials for you today. We previewed what's in this in a memo that we sent around, I think, the last meeting. So I think the substance is probably familiar, and reading a bill can be kind of painful because it gets pretty technical pretty quick. So I just wanted to remind you what the key provisions are and then see if you had any questions. The first retirement provision has to do with the state system, so I won't go over that here. Section 7 of the bill sets up the pension and benefits funding task force. That is building off the work we did with our risk assessments in the spring, and it's putting together a group to look at our amortization policy and, you know, opportunities to revise it in a way that can still have the broad political consensus that our current amortization policy has, but at the same time mitigate that risk that we're going to get as we approach 2038. So what we envision is a much smaller version of the task force that we had a couple years ago at the time of the big pension reform, but to have a really narrow and focused mission to look at the funding policy and specifically and, you know, affirmatively not look at things like benefits, contribution levels, or assumed rate of return, kind of taking that stuff off the table so that we could really focus the inquiry here. The next number of sections 8 to 20 in the bill, they really go to that transfer of fiduciary oversight over the OPEB investments that Eric was talking about earlier in the meeting. It's been the subject of a lot of work already between our office and VPIC, and we think this makes a lot of sense to formally move it from our office to VPIC. I see this really as the culmination of years of work. You know, you go back to 2019 where we had a negative balance in the OPEB fund, and now we're up to over $160 million. So as VPIC moved out of our office to an independent commission, it made sense not to push all of this on them at one time. Assets were still small. Now it's really growing. We're starting to get a practice under our belt of funding these benefits appropriately. And so giving them over to the entity with the expertise, I think it'll both broaden the ability of these assets to earn money, allow for better technical expertise to oversee them. And so I think it's a really good idea. In those sections as well, there's a lot of technical cleanup work Historically, there were a lot of provisions related to VPIC in the retirement statutes. So we're just taking this opportunity to do some geography and moving them out of the retirement statutes and into VPIC statutes. So the statutes make a little bit more sense. Then sections 21 and 22, they do relate to VEMRs and VSTRS. And what they're doing, we had some conversations with the NEA about this. One of the challenges I think that NEA was seeing with was that its president, who's fully released from active service, could not remain in VSTRS and get service credit. And that could sometimes maybe be limiting with who would be able to serve in that role. If, a member can't get service credit for that time. So we took a look at this, and kind of getting back to the purchase idea, we thought that there were a lot of technical challenges with having someone that's not employed by a school in the teacher system, but we came to an agreement that it could work as a purchase. We could, where the service for that year, if we just made it a new category of allowable purchases, could be purchased. And I think that that approach is agreeable to NEA, and so we include that in our omnibus bill. And then the final part of this is we are seeking one additional position, much like VPIC is. We are seeing a substantially additional workloads in our division, particularly related to OPEB. As you heard with all the work that we're doing with our health insurance. It used to be something that, and I think about back when I first started in the office, much of it was just handed over to VHI, and it was kind of in the old traditional model that everyone's used to. And over the past years, first going to VBA and now over to HealthSpring, it's something that we've had to have a much more active footprint, both on the day-to-day level and from a managerial perspective, to understand what's possible and to effectively manage and oversee that program. We also are trying to enhance our oversight of the supplemental plans. Again, back in the old days, those were something that were mostly just handed over to our third-party provider. And as you've seen over the past couple of years, we're trying to internalize some of that governance, kind of like the work that Eric talks about, how VPIC has been moving to underwrite its own funds. We're trying to really own all these plans. And that takes more staff time. I still am pretty surprised that we were able to pull off the HealthSpring transition. And I think it was because of the incredibly hard work of folks like Nicole and Bill and others throughout the office that we were able to make that work. I don't want to have to rely on people working way beyond expectations just to be able to harness opportunities like this. So that's why we're looking for one additional position in the retirement division. Earlier today, when we proposed these positions, both the VPIC position and the retirement position to the state board, they did a motion supporting that. I think that's something that might be helpful. Those positions are not included in the governor's, will not be included in the governor's recommended budget. We'll be advocating for them separately in the policy and money committees in the legislature. And so I just wanted to offer that as an idea for the board if such a motion was something that this board would consider as well. Positions always get to be a pretty tricky issue in the legislature, so having the support of our fiduciaries could always be helpful.
Questions for Tim? I think that, Barry?
Oh, I do have a question, but do we want to? Well, yeah, I'll ask my question, although it's not related to the new position that you'd like us to vote on. I have a question about the task force and the mission of the task force. I'm sensitive to the provision we have now for the COLA formula to change as the funding ratio of the system hits a certain threshold, and as that task force makes changes to the amortization schedule, there's a potential for fiddling with potentially there'll be an effect on when the system would get to those funding levels. And I'm just wondering if the way the task force is structured, if that's being precluded from the discussion, because we're not supposed to talk about benefit, or that task force is not supposed to talk about benefits, and you had a list of a few things. And I'm a little worried that this little piece could get lost in that shuffle. That if we change the funding, if we change the way the amortization works, that could change when the COLA changes are going to kick into effect. And if the task force were to address that, they might not. The task force might be precluded from addressing it because it would be perceived as a change in benefit. It's a technical question, but I'm a little worried about it getting lost.
Yeah, I think the task force as the language is set up, I think it would not address that issue specifically. I think that would be something to address outside of this task force. The focus of this task force would really be on the funding policy. Anything that sort of decisions based on what a change in that funding policy might cause, like, funding levels being achieved at a different time, that would be outside of this task force. And I think probably appropriately so. I think the reason I say that, Perry, is because if opening, I think what we were trying to be careful of was any opportunity to open the door to a benefits discussion in this forum. You always worry that that's the camel's nose under the tent, and no matter how well intentioned, it's something that I think as we were talking to the employee groups as well, I think it's something that was probably a pretty big concern that we not go down that road again.
Yeah. I'm sensitive to that too. I think that's really smart. But I do wonder how do we anticipate addressing that outside issue and making sure that it doesn't get either lost or forgotten, or just not taken care of.
Well, the role of the task force is to come up with alternatives for amortization. So when those alternatives come out, then one of the questions will be, choice A, is there an impact on funding ratio? And then ask more technical questions about what are the unintended consequences of the options that we're going to be faced with.
And Perry, if I can, I'm just sharing my screen because I think the folks thought about this at the time of Act 114, because this is the language that's in statute right now. And starting pretty soon, we're going to be doing reports, and we're going to consider what, it's this board's responsibility, as I think it should be, to kind of consider the funding level and sort of where we are in our funding pattern and how that plays out with the what's currently in the PAAA account and the intent that the legislature set out for a potential future change. So as you see, it could either be on, September 1st, 2027, or at the request of the board in conjunction with the proposed change to the amortization schedule. So I feel like it's this board's obligation to kind of keep an eye on how anything that we're talking about with a proposed amortization change would impact the PAAA and make recommendations accordingly.
Well, thank you. Thank you, Tim.
Sure.
Dan, you have a question?
Yeah, and I'm sorry, it kind of went over my head because I guess in my world, I don't deal with, I don't teach in a school. I'm not familiar with the role of the NEA reps as much. Could you just, so there's a legislative change to clarify, I just want to restate it so I make sure I get it, that if an active teacher says, look, my new role will be sort of the NEA rep rather than full-time teaching duties, that I would still get credit, or did I totally botch? And I apologize, it's really not an area I'm very familiar with, so I just want to make sure I get in my brain what we're saying.
Yeah, and sorry if I didn't explain it well. It's not for
it's probably me. I'm sure it's me, not you. Yeah.
It's not sort of for like a local rep or something like that. This is only for the president. so there's only one, the NEA plan president. So it kind of limits it to that person. And the way it works, and I see Colin is on the meeting, and he could probably speak to this a lot better than I could from a factual perspective. But the NEA president is on full release from duties while they serve in that role. So they're not in the school teaching, and therefore they're not getting credit in VSTRS. I think they're sort of an employee of the NEA at that point. And so the idea is, as someone who came up through VSTRS, I think part of the idea is to encourage maybe folks who are mid-career, as opposed to folks who might just be end career, for, kind of open the pool up to people to potentially consider this role. I think that's some of the rationale behind it. So it's very clear. It's just the NEA president, and that's someone we can easily identify and know who that is.
Thank you. And just again does the NEA itself offer retirement benefits to that person, or are they only looking to essentially the VSTRS pension?
I think currently they have.
Yeah, I don't know.
My understanding is currently they do in the nature of a 401k or something like that.
Oh, okay.
And
But
so
not
the
a,
idea,
not a pension.
not something that's analogous to the VSTRS plan.
Perfect. Thank you so much. Sorry to belabor it outside my area of knowledge.
No, it's all good. But it feels for us, you think about the rationales for service, you have things like Peace Corps, military. It's not like everything has to be specifically teaching. It just has to have some kind of public service or other tie to the system. And when we looked at this, we thought this was a fair addition to the causes for why you can purchase service.
Okay, so at this point, we still have a discussion on the new position vote. Tim, do you have a recommended motion?
I think what I would recommend is to support the position requests of VPIC and the retirement division as articulated.
Do we have someone comfortable making that motion?
So moved.
Do we have a second?
I'll second.
We have a motion and a second. Further discussion? All those in favor of the motion, please say aye. Aye.
Aye.
Aye.
Opposed? Abstentions? Motion carries. Thanks for the update. Next item on the agenda is disability recommendations from the Medical Review Board for PA. Do we have a motion? The packet was in our, go ahead. Do we have a motion to accept what the Medical Review Board recommends?
Yes, so moved to accept the recommendation.
Second,
Excellent.
Hamby.
We have a motion and a second. Thank you. We have a motion and a second. Any further discussion? All those in favor of the motion, please say aye. Aye.
Aye.
Opposed? Abstentions? Motion carries. And we're down to any other business to come before the board.
So far, seen a bug and a cat roll across the
Yep.
screen. I'm hoping no one's large dog comes across.
I promised my cat that Perry would have birds flying around, and she's pretty,
Right,
she's
I
pretty
remember that.
disappointed. She's really disappointed. No birds.
Boy, that was
Sorry
a while
about
ago. Okay, I will entertain a motion for adjournment. We got a motion? Do we have a second?
I'll make that motion, Hamby.
Okay, you're seconding Dan. Dan said.
Oh,
he
Dan.
has the motion. Yeah. So we have motion and a second. All those in favor of adjournment, please say aye. Aye.
Aye.
Opposed? We are adjourned. Thanks very much, folks. Excellent meeting.
Nice to see everyone.
Thanks,
Bye-bye.
everyone.
Thanks all.
Enjoy France, Barry.
Oh, thank you.